Hey everyone, welcome to the KE Report Daily Editorial, Friday, September 5th, here to end the week with our good friend Marc Chandler. Marc is a managing partner at Bannockburn Global Forex, also editor of the Mark II Market website. We try to chat with Marc every Friday to really recap the economic data that's come in, market moves both domestically and internationally. And Marc, we can start off with the jobs data that's come out of the US. And I think broadly we can say that jobs data is continuing to get weaker in the US. Most of the numbers under expectations, even the work week continuing to drop on an hourly basis. All of this is causing the US dollar to sell off, making people think that the Fed is absolutely going to cut rates at the next meeting, but starting to hear rumblings of maybe it'll be a 50 basis point cut. The Fed has said they are focusing, if not more so, on the jobs market outside of inflation. They think they might have a little bit more control in the jobs market rather than the inflation data. But Marc, what do you take away from, again, this continued weak jobs data we've been seeing?
Yeah, I think that, we saw the non-farm payrolls rise a miserly 22,000 in August. And more telling, I think, it wasn't really so much about the downward revisions, which were relatively minor this time at about 21,000. But what really happened was the downward revision in June means that the U.S. economy actually lost jobs in June for the first time since the pandemic. But I think that the market has taken the jobs data. It's not just the jobs data, because remember what's going to happen early next week. The government, the BLS, gives us the annual benchmark revisions to the establishment survey. That's where we get the non-farm payroll numbers from. Last year, when they did these benchmark revisions, they took off about 818,000 jobs. This time, Goldman Sachs, just as an estimate out there, says that we should be prepared for about 550 to 950,000 downward revision. So on Tuesday next week, we're going to get probably some more poor data on the U.S. jobs market. The issue is really what's the reaction function? What's the Federal Reserve going to do? And the market went into this report expecting the odds favored a 25 basis point cut. And like you mentioned, there's about a 10%, maybe a little bit more than a 10% chance now being discounted of a 50 basis point cut. My concern is that this pendulum of market sentiment might have swung too far, because right after we get that benchmark revisions from the BLS, we're going to get the CPI in the middle of next week. And the headline CPI is likely to creep up for the fourth consecutive month. And I think on balance, given this, the deterioration of the labor market, and rising price pressures, I think the Federal Reserve is not going to find a consensus in favor of 50 basis point cut. I think that the prudent thing to do in face of these diverging trajectories of inflation and unemployment should be a 25 basis point cut. And so I think the market pendulum swings back a bit, and we've already seen interest rates drop precipitously in the recent days. I think they find a base, and that might help the dollar steady.
Yeah, it's a good point on that pendulum swinging from the market standpoint as far as the Fed cuts. I mean, like we talked about before, the market's been all over the place with their expectations. I think we came into this year expecting 6 or 7 cuts, and so far we haven't even gotten one yet. So if we get a 25 basis point and they're looking ahead to the balance between the labor market and inflation, how do you think a series of cuts would look, Mark, or what's their propensity to do a series of cuts if inflation keeps trending higher, let's say for a fifth month or 6 month? If we keep seeing the delayed effects of inflation and maybe some of those tariff effects finally come in, what does that mean for the rate cutting cycle, the series of them that many people expect to happen?
It's an important point because, when the Federal Reserve does meet, they're going to be updating their summary of economic projections, the famous dot plot. I think that the way the Federal Reserve sees it would be that I think that a majority are beginning to talk as if the tariff increases impact on prices can be short-lived, would be one-off, even if the tariff increases aren't just one-off. That is, we should be expecting more sectoral tariffs in the coming weeks to be announced from the U.S. I think that when push comes to shove, the Federal Reserve more concerned about the deterioration of the labor market than the firmness in the inflation numbers. Partly, again, they see the inflation numbers perhaps as just temporary. And secondly, with the unemployment rate rising, the labor market slowing, I think that many people in the back of their head, like the kind of model they have, would suggest that the slower growth, weaker jobs growth is going to eventually squeeze price pressures. That is to deny corporations pricing power.
Fact of the matter is, too, I feel like the Fed is focusing on the jobs market because this inflation argument so much is also around tariffs, and they have no control of tariffs. We don't know what's coming out of Trump in terms of tariff tomorrow, the next day, the next few months. So I feel like the Fed is just saying, look, at least we might have some control in the job market, and if we can, well, help the job market and maybe slow down wage growth, maybe that'll help inflation, but they are in a tough spot. But Mark, doesn't this mean that when the Fed starts cutting this month, even if it's not 50 basis points, probably won't be, there's no light here at the end of the tunnel that's saying inflation's coming way down, the job market is going to drastically improve. This really does seem like this is going to be the start of a series of rate cuts, much like we saw from other central banks around the world. The Fed now is just getting pushed into this.
Yeah, I think that how I would characterize it would be that the Federal Reserve, at least most Fed officials, see the policy setting now somewhat restrictive. And so rather than really easing policy, they're going to be removing some of the restrictiveness. But I hear what you're saying, and I think that the rate cuts, and I agree we should be expecting a series of rate cuts, whether it's over the next 3 months, 6 months, a year. We should be looking for lower interest rates. And I think that we could see a further steepening of the U.S. curve. It wasn't that long ago we were looking at, say, back at the end of Q1 around a 25 basis point positively sloped curve, and now it's almost 60 basis points. And so I think that's partly what the market is telling us is that the Fed, by moving their focus to the labor market, that they're going to tolerate a bit more inflation for maybe a bit longer. And of course, the net consequence for savers is to expect a steeper curve.
Well, Mark, to that point about the interest rate curve, that obviously plays into some of the dynamics in the US dollar. The Fed can really only affect the short end of the curve. The long end of the curve is kind of marching to the beat of its own drum. But to your point, we have seen the yields kind of spread out a little bit, which you'd want to see between the short end and the long end. But how do you think that plays into the US dollar movements that we're seeing?
Well, I think that the dollar has sold off. I had thought that after that Powell speech at Jackson Hole on August 22nd, I thought that was a green light to sell the dollar. And it's only really until today, with the jobs data, they were really seeing that August 22nd dollar index lows being convincingly taken out. So, but what concerns me again is this pendulum has swung a bit far, given the political uncertainty coming in France at the start of the week, the possible downgrade at the end of the week, and we've got that inflation number in the middle of the week. I'm kind of thinking that maybe we could see the dollar bounce. Not so much, maybe it bounces after we get that jobs revisions on Tuesday and into that CPI number. So I think the pendulum swings back and the dollar finds a bit of support. Of course, we got up to 117.60 in the euro. It's just below the late July highs and also those highs we saw, the multi-year highs in early July. So while the dollar, that put it this way, then the euro is near the upper end of its recent range, and I think that it doesn't really make new highs. And we got to clear out a little bit of more news. We've got to see what happens in Europe, and we've got to really see what the Fed says on the 17th.
Mark, regarding the bond market, I find it interesting. You look at almost any time frame, or especially the 10 or the 30 year, nothing's really happened. It's range bound. For as much as markets are moving higher, we talk a lot about gold and silver. Those are moving higher. The dollar has been threatening to break down, but that's trying to hold some of these lower levels. But there just hasn't been much action in the bond market. Why has it been so boring with everything else that's going on?
Yeah, I don't know. Maybe it's you're sitting a bit further north than I am, but I've got the U.S. 10-year yield getting close to 4%. We got down to 4.06 today after the jobs data. We were testing 440 in early August. I think what's hard for a lot of people, I think, is we had this narrative about how U.S. lost its exceptionalism, foreigners were boycotting U.S. assets, and yet when I look at the 10-year yields, the U.S. 10-year yield is down 50 basis points this year. It is the only G10 bond market, looking at the 10-year yields, that's actually lower on the year. German Bund, the 10-year Bund is up 30 basis points. The Japanese 10-year is up almost 50 basis points. So I think in some ways, the U.S. Treasury has done very well for investors compared to other major bond markets. I think there are there are some conflicting forces. And what I'm watching, and this is something I think also that the Federal Reserve may address. So when they meet on the 17th, so we agree they probably will cut rates 25 basis points. They update the summary of economic projections. But the other big, like 800-pound gorilla in the room is QT. Remember how this works. The Federal Reserve is allowing some issues of treasuries and mortgage-backed securities to mature without replacing them. And as and what we're seeing happening now, where this extra reserves are being found, is really in the reverse repo market. And yet the demand or the usage for the reverse repos continues to fall. This is telling me that we're probably approaching the level where reserves are adequate or ample. And this will raise the volatility of the bond market if the reverse repos completely dry up. So I'm concerned that at the FOMC meeting, they may have to say something about QT, either stopping it or more likely announcing more plans to just sort of taper it so they don't repeat what happened in 2019 when they let the reserves fall too low and it injected volatility into the treasury market. We already have, the move, which is the bond market equivalent to the VIX, is already pretty firm. We're at the upper end of where we've been for the past 2 months.
Yeah, Mark, it's a good point about QT, and also QT is the quantitative tightening in a way is in contrast with cutting rates. So it'd be probably good to phase that out or stop it altogether, but they'll probably taper it down. Now, you brought up, what we're doing in the US, but when we look internationally at how other bonds and interest rates relate, it relates to what their central banks are doing. Most central banks are way ahead of the Fed and their cutting cycle, where we thought some of them were actually tapering down their cutting, but now a few of them may have to do an additional cut. Are there any international markets that you think are in, the driver's seat as far as how their rate policy will tie into their monetary policy?
Well, I think that Canada is really on the bubble. Many people thought, and Bank of Canada sort of hinted that there might be maybe one more cut in the cycle. The market was leaning against it. But in the past 10 days or so, we've had a very weak Q2 GDP, a bigger contraction than expected, and mostly that's because of trade with the US. And we had on Friday a weaker than expected jobs report with the unemployment rate rising further than people thought. And so what the market is doing is it's raising the odds that the Bank of Canada cuts rates in September, in addition to another rate cut later on in the cycle. So I'd say the big shift, I think, in recent days has taken place in Canada. But also we've seen comments from the Reserve Bank of Australia Governor Bullock after some recent stronger than expected consumption data saying that maybe that could also, if it were to continue, affect their trajectory. The Bank of England has also made it clear that they're in no hurry to cut rates again, and the market has really pushed out the next Bank of England rate cut well into next year.
So, Mark, when we look internationally, it just seems like in the US, we're still talking a lot about if a recession is coming. We have seen weakening data, inflation ticking up, growth still there, albeit small, but the argument being it's such a mature economy that even slow growth is still growth. Are we seeing any other countries out there that are a beacon of hope, that are growing faster, that seem to have control of their fiscal house more so than the US? Somewhere else that we can point to that says, look, these guys are more on track compared to the rest of the world.
Yeah, I don't know. I mean, partly because most of the other countries that might be growing faster are too small to really matter for the world economy. So yeah, I think this is the tough spot that we're in right now is what's going to be the locomotive for the world economy. The German economy, as I mentioned, very poor factory orders. They're still struggling to show any kind of forward momentum in the economy, despite all this spending that supposed to do on infrastructure and defense. We'll get some real sector data from China in the next couple of weeks, but even there, I'd say, well, Chinese growth looks stable, say around 5%. It's also not having much forward traction. And there's probably going to be more stimulus coming from China before the end of the year. So yeah, so I think that that's part of the tough spot that we're in is it's just not clear where those growth impetus is going to come from.
Well, Mark, speaking of tough spots, we haven't talked about France yet. What are your thoughts there as far as what's going on politically and possibly how that affects their financial system?
Yeah, so France on Monday, that's part of the reason why I'm not so bullish on the euro after we saw that rally up to about 117.60 on Friday. And I'm thinking that there's like a snowball's chance in hell that the government's going to survive this vote of confidence. All the major parties have said they're not going to support the prime minister. What the prime minister's trying to do is reduce the budget deficit from 5.4% this year to 4.6% next year. And there's just not the political will to do that. And what Macron could do, Macron is on a second term, and there's a two-term limit. So if he were to call for general elections, it's as if he'd be resigning. So he's not going to do that. He could call for new parliamentary elections, but the last time he did that, and this is sort of the mess that we're cleaning up from, in effect, that parliamentary election was not very decisive, and it's really fragmented parliament. So he's most likely going to do is appoint a new prime minister, but he's got to accept that he's not going to get that fiscal austerity that he wants. And I think that, to your point, we're seeing a similar type of thing in the UK, where the UK is going to have a budget announcement in late November, and the Labour Party that's in Parliament is to the left of the Labour Party that's in government. That is, the Labour Party in Parliament does not want the austerity that Starmer and his team want to impose. So I think we've got this tension really between these forces. But in France, though, the government falls, and to me, the problem that's lurking is that Fitch has France's double A minus credit rating on Credit Watch with a negative outlook. And the concern is the lack of progress on the deficit. So I could imagine where the government fails on Monday, Fitch downgrades them on Friday next week. And this might have some contagion impact, some knock-on impact among other weaker credits within the Eurozone, like Italy. The amazing thing about Italy, I think, is that, the French yield is almost at the Italian yield. And so that just illustrates sort of the pressure that's really on France. The spreads, and that's how it's measured, this tension, is the spreads between Germany and France have widened out to almost as wide as Italy. And so I think that's the problem, is how does Europe, which continues to pursue this fiscal, like pro-cyclical austerity. You'd think that what typically happens is when the economy weakens, countercyclical spending kicks in and deficits grow. But what's happening is that as the economy is weakening, the GDP, the deficit to GDP rises. And this is the constraint that European Commission imposes on European countries. And that's the problem, is that in weak economic times, deficit grows as a percentage of GDP, and they're under more pressure to cut spending.
So it doesn't sound like things are going well in Europe either. And when we look at the dollar, at least on the dollar index, with how much the euro is weighted in that, why is the US dollar breaking down so much if Europe also has it pretty tough?
You know, It's an important point I think you raise here, because I know that economic theory would say that should be focusing on interest rate differentials. And I do look at interest rate differentials like US, Germany, the 2 year, which is at new lows for the year. The US premium is at new lows for the year. But in my work, so if you try to leave aside trying to explain why something's happening and just like let's observe what is happening. And I think that what is happening is that the US dollar is sensitive to US interest rates, not necessarily interest rate differentials. I find, for example, that the US 10-year yield is highly correlated to the dollar yen movement, more so than Japanese interest rates and more so than the interest rate differential. So we can come up with all kinds of narratives and try to explain why this is the case. But to me, the takeaway really is that if you think the US economy is slowing down and US interest rates are going to fall further, I think that what leads me to the conclusion that we should still be expecting further dollar losses. The dollar index, we're going to have the lowest close perhaps of at about a month ahead of the weekend, and we're trading around 97.65. And I think I suggested to you guys previously that we could be headed towards 95, and that might be a conservative target.
Well, there's a lot of people expecting the dollar to keep staying weak, so we'll see how it goes. But Mark, just as we look ahead, aside from the potential rate cut from the Fed and I guess the expected rate cut, is there any other economic data that you see coming over the next week or two that really moves the needle for the economy or the markets?
I think that there's really only two things that really matter right now from the U.S. perspective, and that is the jobs market, which will get, like I say, that update on Tuesday with the benchmark revisions, and inflation. And then we get into the Fed. I think those are the two things. I think for most countries, those are the only two real variables of leaving aside, like, the headline reaction to different economic reports. But the real thing, I think, right now is the direction of U.S. interest rates, the direction of inflation, and the general economy using the labor market as a proxy.
All right, enough said, Mark. Interesting way to end the week and really just solidifying the weakness in the job market that is continuing. And then next week, inflation data. Boy, oh boy. And then shortly after that, Fed with a rate cut. What size is it going to be? Most likely 25 basis points. Might be 50, but again, sounds like still the consensus very much 25 basis points and a potential start in a trend of cuts. We'll see how it all plays out, but markets were volatile this week, fought back throughout the week after a bad start to the shortened trading week, and then ending the week a little bit on their back foot. So, man, oh man, always a lot going on in these markets. And right now, still a lot of, I think, question marks in terms of U.S. economy, but sounds like everywhere else is struggling too. Mark will wrap it up here. Again, Marc Chandler is a managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. Click the link in the show notes to follow along on a daily basis with what Mark is covering. Mark, thank you so much for your time today. I hope you have a great weekend.
Thanks, and good luck to everybody.